We'll begin with the responsibility centers. Then we'll go for divisional performance measurement. So what is a responsibility center? A division in charge or responsible for something. What do you mean by in charge for something? This can be split into a cost center. A cost center where where cost is incurred. Simple, they are responsible for optimizing the cost. Optimizing the cost versus quality. That is for the first center, cost center. Maybe a factory or maybe a production spot. Okay. Or the place where you buy and store the raw material. Here only cost is incurred. There will be no revenue. There will be no revenue. We are responsible for optimizing the cost, and which one? Of course, you have to consider quality also. Second, we call it as revenue center. Simple, responsibility for creating sales. Revenue centers are those which are responsible for creating income. Simple, maximize revenue or sales. That is objective. Probably a showroom, a sales depot, or a outlet of a company. Let us take Indian Oil Corporation in India, or let us take Bharat Petroleum. They have got both cost centers as well as revenue centers. Cost center is where the boilers and processing units are there. The plant is there, where they have to optimize the cost by minimizing the wastages. Okay, ensure the quality and other things. Revenue centers are the sales outlets. Okay, sub centers or like franchise outlets or agents outlets or direct company owned operated systems where they are responsible for making what? Revenue or sales. And the third one is profit centers. Profit centers will have both cost as well as what? Income. It will have both cost as well as revenue. They are responsible for creating profit. They are responsible for creating profit. So they are called as which centers? Profit centers. Clear? So cost center, you manufacture the product. What is the objective of cost center? Minimizing the wastages, utilizing the resources, optimum quality material usage or labor usage or production usage, capacity utilization for the machines, capacity utilization of the factory, ensure lesser idle time, more productive time. Okay, ensure that there is no accident or stoppage of work. Ensure that smooth flow of work is taking place, and ensure that the bottlenecks are removed. What is a bottleneck? Simple. There will be many processes. One process alone will take much of time. One process alone will take what? Much of time. Okay, that process you add more processes or try to reduce the bottleneck time so that the production flow take place in a proper way. It also includes factory layout in such a way that the production flows smoothly and without stoppage of work or whatever. Better facility and workers management. All those things are covered in which one? Cost center. The objective is optimizing the cost by improving the performance of workers, machines, factory, and of course reducing the wastages or idle time and all. Revenue centers are there to create income, better marketability, after sales service, customer care, okay, customer handling. So many factors matters a lot for for bringing which one? Revenue. So they are responsible for that. Profit centers where you will have both cost as well as revenue, match it and find out what? Profit or loss. In India, you find Reliance Digital or Reliance Retail. That is a profit center. They've got a cost of the products, and they've got revenue from various outlets. So they are responsible for creating which one? Profit. So responsibility centers are of three types. Now, how to measure a divisional performance? How to measure a divisional performance? If it is a cost center, we are going to measure based on how to measure the performance based on input output ratio. For example, this is a quantity of input of raw material. This is a quantity of output of finished product. What is the process wastage? Is it within the normal thing or not? Then idle time, We work out efficiency ratio. Efficiency ratio is nothing but actual output divided by expected output into 100. It can be for men or it can be for machines. Okay, workers or machines, you can work out which one? Efficiency ratio. You can also work out capacity ratio. For example, what is the normal production capacity? What is the actual production capacity achieved? So you can work out capacity ratio, and you can work out cost ratios. Cost ratios based on standard cost. You can compare with actual cost, and you can do variance analysis. This is the method of performance evaluation. This is the method of performance evaluation for a cost center. For a cost center. For a revenue center, the performance appraisal can be based on budgets versus actuals. That is target versus actuals. We can do sales variances, or we can work out, sales variances of different divisions and departments. We can work out and report why there is a positive variance, why there is a negative variance, where and all it is achieved, overachieved, or lesser achieved, so that you can report with respect to what? Revenue centers. For profit centers, since there is a both cost as well as revenue, since there is a cost as well as what? Revenue, we work out an income statement. We work out which one? Income statement. Income statement with the cost analysis we'll work out. Income statement with the cost analysis we work out for different profit centers. Revenue minus cost. What cost? We've got variable cost, fixed cost, and we've got common costs that are allocated. For example, let us assume you are running a departmental store with 4 divisions like vegetables, cosmetics, or medicines and cloth stores like that. Income can be identified directly. Certain expenses are direct. Certain expenses are not direct. They are spent commonly. For the entire departmental store, we will incur a common cost. How to apportion the common cost? Certain common cost may be controllable. Certain common cost cannot be controllable. So preparing an income statement division wise is a big problem. Clear? For example, I am having 4 division or 4 section of a departmental store. Revenue can be identified separately. Direct cost can be identified separately. Variable or fixed cost can be identified separately. The problem is how to identify indirect costs. For example, you are doing some marketing exercise. How to apportion marketing expenses? Should it be based on turnover? Should it be based on what? Turnover. Some arguments may be for, some arguments may be against it. Okay. How to allocate usage of electricity? For example, for 4 frozen products, more electricity is consumed. In medicine section, lesser electricity is consumed. In cosmetics, some electricity is consumed. In vegetable section, some electricity is consumed. How will you allocate the common expenses? Again, common expenses may be variable or fixed. It may be controllable or what? Non-controllable. So, while preparing an income statement, you can prepare a common income statement easily. A single column income statement can be prepared easily. But the problem is preparing a multi-column or columnar income statement for different departments is a difficult task. Because while preparing income statement, direct costs, we call it as a traceable cost. Traceable cost can be variable cost or it can be which one? Fixed cost. And the variable cost, traceable cost can be classified into manufacturing cost, manufacturing related costs, other costs. This can be further classified into controllable versus non-controllable. Certain variable cost you can control, certain variable cost you cannot control. Same way, fixed cost can be classified into manufacturing related and others, which may be controllable or what? Non-controllable. And indirect cost will be there. Indirect cost means common costs. Again, common cost may be variable or fixed, it may be controllable or what? Non-controllable. For example, rent paid for the showroom, which is having 4 divisions. Is it variable or fixed? Fixed. Is it controllable or not controllable? It is not controllable. Rent is fixed by other people. Electricity charges. Electricity charges may be variable. Okay, it may be related to manufacturing or it may be related to others. But electricity charges, is it controllable? Partly controllable, partly cannot be controlled. The rate you cannot alter, but consumption can be minimized, optimized. It can be optimized. So the problem of preparing the income statement is allocation of cost. So for a departmental store, 4 divisions are there. Direct cost, you can directly allocate it. But what about common expenses? What about controllable expenses? What about non-controllable expenses? It is difficult. It is difficult to prepare an income statement for which one? Performance appraisal. But policy should be created after thorough analysis of product, processes, people, departments, products. So many factors you have to consider in allocating which expenses, indirect expenses. Okay, rent, can it be just allocated based on area? For example, rent normally is allocated based on area occupied. Cosmetic division this much. Okay, vegetable section this much. Medicine section this much, like that. But sometimes people will say cosmetic divisions require only this much, but vegetable section requires a larger space. Provision section requires a much larger space. Medicine section requires only a small space. That is a requirement. So people may argue allocate the rent equally. Or sometimes people may say allocate the rent based on the area occupied. Then what about unoccupied spaces? So we will have a lot of hiccups in allocating what? Common expenses or apportioning which one? Common expenses. So cost center it is easy to work out. Revenue center it is easy to work out based on budgets variances. But profit centers, preparing an income statement is a tough task. Preparing an income statement is a tough task. Consolidated income statement you can work out. Total revenue, total variable cost, total fixed cost you can work out. But segment wise, working out the cost is a tough task. There is a practical scenario where a lot of discussions will be held, arguments will be put forward, then a logic will be developed in apportioning which one? Costs. Clear? So for preparing income statement, there are 2 words we use. One is called as traceable. This refers to direct items. Any expense or income which can be directly attributed to a department, we call it as which one? Traceable cost, which may be fixed, which may be variable, which may be related to manufacturing, which may be related to selling or administration. Any cost that can be directly attributed, we call it as which one? Traceable cost. For example, I am the in charge for medical department or medicine department. I am the supervisor. So my salary will be a direct expense for the medical section. You are the in charge for, let us assume, cosmetic section. Your cost will be assigned only to the cosmetic section. Okay, that's what, it's a labor cost. It's an example of which one? Labor cost. We may be a manufacturing labor or a selling labor. Okay, for example, material purchased can be identified directly with each department. That is called as which cost? Traceable cost. That is called as which cost? Traceable cost. Next one we call it as common cost. Common cost has to be apportioned on a suitable basis. For example, there is a general manager for the stores. There is a general manager for the stores. The salary to the general manager should be apportioned amongst various departments. On what basis? You have to put forward, depending upon the nature of organization. It can be based on number of employees working, or it can be based on sales revenue, or it can be based on volume and value of material, or it can be based on space occupied. So there can be different parameters in which, wages of a general manager can be apportioned. Rent. Okay. So it has to be apportioned based on floor area or based on the volume of or quantity of goods stored, all those things. Security expenses, advertisement expense and all, they are apportioned on a suitable basis. What is a suitable basis? Depends on the organization, organizational policy, logical reasoning behind what? Apportioning them. Only when you do this, then we can evaluate the performance of a profit center. We can evaluate the performance of a profit center. We learn through an example that is better. We learn through an example that is given in the material shared with you. No need to copy this example. That is what? Common cost has to be allocated. Common cost has to be allocated on a suitable basis. On a suitable basis, we have to allocate. Look at this income statement. There are two divisions we want to evaluate the performance. There are two divisions we want to evaluate the performance. Revenues are identified separately. It's a traceable item. So total 10,000. The company runs with two divisions. Total revenues how much? 10,000. Reduce variable manufacture overheads only. So sales minus variable manufacturing overheads. This is called as contribution margin level 1. This is the first level contribution that comes from the product. The first level contribution that comes from the product is sales minus manufacturing cost only. Then eliminate variable non-manufacturing costs. Non-manufacturing cost may be administration related expenses, selling related expenses. This is called as contribution. Contribution is nothing but sales minus all variable cost. Clear? Deduct both variable manufacturing cost as well as selling and distribution cost. You will get which one? Contribution. Then controllable fixed cost. Controllable fixed cost this is nothing but the management can decide altering the fixed cost or can influence the fixed cost. If they want, they can spend more. If they want, they can spend less. So this will give us controllable margin. Then non-controllable traceable fixed cost means direct fixed cost but cannot be controlled. Cannot be controlled is nothing but contribution margin from the business. It is a contribution margin from the business. Any common cost which cannot be controlled spent by the company, like common borrowing cost, common branding cost, like auditors fees or like general administrative charges, board of directors charges, that will not be charged to the division. That will be charged in the total profit of the company. What is the total profit? $2,250. In that the $1,000 will be charged and you will arrive at which one? Operating income. You will arrive at which one? Operating income. Now, if you want to see the product's performance, this level 2 should be seen. Sir, I want to evaluate the product. Performance of the product. Performance of the product means look at the contribution margin. Contribution margin. If you want to evaluate the performance of the manager, performance of the manager of a division, go with which one? Contribution margin for segment manager's performance. Why? Because he cannot control everything. So take only controllable fixed cost. Take only which one? Controllable fixed cost. Okay. Eliminate it. Find out the profit to eliminate or to evaluate which one? Manager's performance. Do not deduct non-controllable fixed cost. Do not deduct non-controllable fixed cost to evaluate a performance of a manager because that fixed cost, the manager has no control on it. But to evaluate the business unit, department as a whole, I will evaluate after eliminating variable cost, manufacturing, others, fixed cost, controllable as well as what? Non-controllable. I will work out the operating income from the departments and I will eliminate. And please remember, while evaluating the department, do not include non-controllable, untraceable common expenses because they are corporate office expenses. They are not connected to our operating item. So like this, they can give an income statement. It is an essay type question that can be tested. It can be an essay type question. It can be tested. How will you evaluate product's performance? Question number 1 can be the product performance evaluation should be done based on contribution margin. Okay. How to evaluate manager's performance? Based on the contribution after eliminating what? Controllable fixed cost. How will you evaluate the performance of the department as a whole? Then all traceable costs. Sales minus all variable cost minus all controllable and uncontrollable fixed cost. What is the net operating income generated? That is what going to be used for evaluating which one? The segment's performance. So if you want to evaluate the division's performance, take this and proceed. Then how to evaluate? There are approaches. First approach is return on investment approach. First approach is which one? Return on investment. For evaluating manager's performance, for evaluating division's performance. Simple. How to work out return on investment? You will take which one? This level 3 contribution. divided by sales or revenue into 100. This is for evaluating manager's performance. For division's performance, you take which one? Level 4 contribution divided by sales into 100. This is one approach. This is first approach of evaluating division's performance and versus manager's performance. Number 2, residual income. Residual income. Simple. Actual income level 3. Compare this with target return on investment. Target return on investment. You will get residual income. So if the manager is able to make more than the target return on investment, yes, performance is positive. Same way, for the division, take the actual income in level 4 and target at ROI for the division. This is for the division, not for the manager. Then you will get which one? Residual income. Based on that, division's performance can be measured. Variance analysis can be done. Simple. Sales margin variances. We had seen in the previous session. Sales margin variances we can use to evaluate the performance of manager as well as what? Division also. Like price variance, quantity variance, mix variance, efficiency variance, we can work out and we can evaluate which one? The manager's or division's performance. This is another method. See, depending upon the nature of company that you run, you can evaluate the performance of the manager versus what? Division's performance. Please remember, manager's performance evaluation is different from division's performance. For evaluating the manager's performance, we'll take only controllable cost. For division performance, all cost will be assigned. Both controllable as well as what? Non-controllable cost will be assigned for evaluating division's performance. But the problem of this one is sometimes there is a problematic division. The problem may be a labor problem or material problem or a marketing problem or sales problem. In that area, you may be posted as a manager. You may be posted as a manager. Then if you're applying these methods, then you're doing wrong. Already the division is in a problem. In that situation, the manager is posted. If you evaluate based on ROI or residual income or variance analysis, then the manager's performance evaluation will not give you what? Real results. So their evaluation should be done based on qualitative parameters. Whatever we are talking here is only about financial and quantitative parameters. We don't consider qualitative parameters. How much of problem solved? From loss, how much it is created as profit? Okay. Or the unit which was not working, how that was made working? Or capacity utilization before and after the appointment of manager? Or problem solved before and after the manager's appointment? Like that, you have to look into the non-quantitative parameters also and evaluate which one? Manager's performance. Now sometimes because of organizational politics, you may be posted in a problematic area. Then if you work out ROI, residual income, variance analysis and all, everything will be negative and your performance appraisal will be what? Negative. So in those certain special zones or divisions where in which some problems are there, you should look into other cost and non-financial parameters also and evaluate what? Manager's performance. Why manager's performance is evaluated? Simple. For better rewards, for promotion, and for recognition, and overall organization's performance. Overall organizational performance. We had discussed about mission, vision. To achieve the mission and vision in the long run, we have to evaluate what? Both manager as well as what? Division's performance. So this is about performance appraisal. This is about which one? Performance appraisal. Where whatever we discussed, the level 1, level 2, level 3, level 4 would have been discussed in your material also. You can go through. So we discussed this particular, what is a responsibility center? What are the different types of responsibility center? How to measure which one? Divisional performance. That is what we have seen. That is what we have seen. And evaluating a manager's performance is different from what? Division's performance. Sure, short, you will get an IMA question based on this. Okay. They will give you a wrong statement and tell that manager A is not performing, B is performing. Then you would reallocate the cost, because only controllable cost should be allocated for evaluating which one? Manager's performance. So when you reallocate the cost, you may find division A, which was given in the problem, is not performing well, may be performing. Division B, which is performing, may not be performing like that. So please keep it in mind, manager's performance evaluation, variable or fixed cost, only controllable cost should be taken. Division performance, all costs can be taken, all costs can be taken. And in both, what cannot be taken is non-traceable cost. What do you mean by non-traceable cost? Costs that are not associated with your division's operation. They are called as corporate office expenses. I told you already. Directors' fees, administration charges, general office expenses, maybe like auditors' fees. Okay, those things cannot be attributed to a particular division. Means don't assign the cost. Don't assign the cost for evaluating which one? Division's performance also. So this is about which one? Responsibility centers and performance evaluation.